Today, we're going to fundamentally rewire how your brain perceives a market crash. We're going to take that terrible, visceral feeling of panic you might have felt in the past, or maybe that you're afraid of feeling in the future, and completely transform it. We're going to turn that fear into literally the single greatest wealth-building opportunity of your life.
So picture this for a second. You're sitting on your couch, random Tuesday morning, sipping your coffee. You decide to pull out your phone and check your investing app. You're just expecting to see that slow, steady, boring upward climb you've totally gotten used to. But instead, shock. The market has absolutely tanked, down 4% in a single hour. You refresh the app because, hey, it's got to be a glitch, right? But it's not. You get that instant, heavy knot in your stomach as it feels like your entire life savings are just evaporating into thin air. You flip on the TV, and the financial news networks are in absolute meltdown mode. The screen is literally bleeding red. Anchors have their sleeves rolled up, they're shouting over each other, and these giant banners are flashing terrifying words at you. You know the ones: plunge, bloodbath, crisis. And suddenly you have this overwhelming, almost uncontrollable biological urge screaming in your head to hit the sell button. But why? Why is our immediate instinct to just run for the hills?
Well, that brings us to part one, the seduction of pessimism, and why bad news just somehow sounds smarter than good news.
See, we are essentially hardwired to instantly believe apocalyptic prophets. Take this guy, Igor Panarin, a Russian professor. Back in 2008, he had a front-page Wall Street Journal article predicting the U.S. economy would completely collapse and literally break apart. And people listened to him in absolute terror. Now flip that, and look at post-World War II Japan. If someone back then had predicted their economy would miraculously grow to 15 times its pre-war size in just one generation, they would have been laughed right out of the room. But that incredibly optimistic prediction, that was the actual reality. Pessimism just sounds smarter and more urgent to our survival-oriented brains. And psychologists have actually proven exactly why we do this. It turns out the emotional pain of losing money is more than twice as intense as the pleasure of making it. So when the market drops, your brain's fear center essentially hijacks you. It pumps you full of anxiety and completely blinds you to rational thought. You sell to stop the bleeding, thinking you're being responsible and protecting yourself, when in reality, you're locking in a deeply destructive financial mistake.
Which leads us to part two. Meet Mr. Market, your emotionally unstable business partner.
So instead of thinking of the market as this giant, intimidating machine, imagine it as an actual guy, a manic-depressive business partner named Mr. Market. Every single day, he knocks on your front door offering to either buy or sell shares with you. Some days, he is completely euphoric. He sees endless growth, and he bids the price up to the moon. But other days, he's absolutely terrified, totally in despair, and he's begging you to buy his shares for pennies on the dollar. The truly wealthy investor gets that you don't have to trade with him every day. You only buy when he's in utter despair, and you just ignore his yelling the rest of the time.
Basically, you have got to train your brain to treat a terrifying market crash exactly like a thrilling clearance sale at the supermarket. Think about it. When the local grocery store drops prices on ground beef by 50%, what happens? Consumers rush in, they stock up, they fill their carts, they're thrilled about the deal. But when the stock market has a 50% off sale, which by the way we call a crash, that exact same consumer runs out of the store screaming in absolute terror. It's totally absurd when you think about it. The intelligent investor reverses this logic. They actually feel a thrill when the market drops because they know profits are made when you buy, not when you sell.
Okay, part three, the ultimate offensive weapon. Let's talk about automating your survival through some pretty brutal math.
This weapon we're talking about is called dollar cost averaging. It's simply the practice of investing a fixed dollar amount into the market at regular intervals, say every single month, no matter what the market is doing. By putting your money on permanent autopilot, you unlock this incredible mathematical superpower. When the market crashes, your fixed investment amount automatically stretches way further, scooping up heavily discounted shares. You are systematically forcing yourself to buy low. Let's look at the actual math here to prove how powerful this is. Say you invested $12,000 as a massive lump sum right before the devastating 1929 crash. 10 years later, you'd only have about $7,000 left. Just a massive, painful loss. But if you had committed to dollar cost averaging instead, investing just $100 a month, starting right before that exact same crash, and going straight through the darkest depths of the Great Depression, your steady, relentless buying of cheap shares would have grown your money to over $15,500 10 years later. You wouldn't just survive the worst bear market in human history, you'd profit from it.
And the best part? This mathematical strategy completely immunizes you against panic. Imagine a panicked coworker sprinting up to you in the break room, freaking out, asking if you saw the market plunge. You can calmly, maybe even a little smugly, hit them with the most powerful phrase a long-term investor can use. I don't know, and I don't care. Why? Because your automated system is just sitting there, quietly buying up shares at a massive discount for you.
All right, moving to part 4, getting versus staying wealthy. This is the fascinating 1929 tale of two millionaires.
Back in 1929, right during that historic crash, the lives of two incredibly wealthy men crossed paths. On one hand, you have Jesse Livermore, who was arguably the greatest stock trader of his generation. He actually shorted the market right before the crash. And get this, he made the modern equivalent of $3 billion in a single week. He was basically a financial god. On the other hand, you have Abraham Germansky, a multimillionaire real estate developer. He bet his entire fortune heavily on the market continuing to surge. He was completely wiped out. Tragically, he was last seen wandering Wall Street, literally tearing ticker tape into shreds like a madman. So the crash destroyed Germansky, but it elevated Livermore to legend status. But here is the crazy, tragic twist to the story. Just 4 short years later, overflowing with this feeling of invincibility, Livermore started making wilder and wilder bets. He eventually lost every single penny of that fortune and took his own life. The harsh reality is that both men lacked the most essential trait of all, survival. They were incredibly good at getting wealthy, but tragically bad at staying wealthy.
At the end of the day, survival is everything. Ben Graham always taught that compounding relies on sustained, uninterrupted returns. And the only way to actually ensure you survive is by building a margin of safety. Think of it like engineering. An engineer builds a bridge to hold 30,000 pounds, but only allows 10,000-pound trucks to cross it. You have to build that same room for error into your financial life. You need a boring, large cash emergency fund. Why? Because if you lose your job during a crash and have zero cash buffer, you are forced to sell your beaten-down stocks just to pay your rent. You turn a temporary paper loss into a permanent, devastating reality.
And actually, having that massive margin of safety is exactly what lets you go on the offensive. During the really nasty early 90s recession in Phoenix, terrified people were liquidating their properties left and right. Robert Kiyosaki saw this distressed market and marched straight down to the bankruptcy courthouse. He found homes that used to be worth $100K, now sitting there distressed at $20K. He bought them using a small $2K loan from a friend and then turned around and resold them immediately with owner financing for $60K. He created massive passive cash flow without even using his own money, all because he survived the initial crash and pounced while everyone else was paralyzed by fear.
Which brings us to our final section, part 5, the price of admission. Let's completely redefine what it is you're actually paying for when you invest.
See, the average person looks at a 20% market drop and they view it as a fine. They see it like getting a speeding ticket from the IRS, just this brutal, annoying penalty because they did something wrong. And human nature says we should sell out of fear to avoid getting punished anymore. But the quiet millionaire? They view volatility as a fee. They view it like buying a ticket to Disneyland. Sure, it's really expensive, but it is the mandatory cost of admission to get into the ultimate wealth-building machine. They just calmly accept the pain of a bleeding red portfolio because they know it's the required fee for long-term financial independence.
You also have to just completely ignore the short-term speculators. Seriously, stop playing someone else's game. Think back to the dot-com bubble. Long-term investors were watching day traders make this insanely easy, rapid money, and they innocently started taking cues from them. They abandoned their totally fine, boring strategies and started buying up wildly overpriced internet stocks. Well, when the bubble finally burst, the short-term traders just moved on to the next thing. But those long-term investors, their life savings were literally incinerated. Let the TV pundits and the day traders panic. You stay quiet and you stay the course.
So, what's our action plan today? I highly recommend you sit down and physically draft an investment owner's contract for yourself. Build your psychological bunker right now before the next crash inevitably shows up. Commit solemnly to dollar-cost averaging every single month. Refuse to let panicked strangers on TV make your financial decisions for you. Commit to never selling an asset simply because the market is down, and audit your margin of safety. Stop buying liabilities, cut your expenses, and stockpile those cash reserves until you are financially unbreakable.
I want to leave you with one final thought to really challenge this new perspective. Remember, wealth is always transferred during a crash. It moves rapidly from the fearful to the prepared. So how do you plan to deploy your cash the next time Mr. Market decides to hold a 50% off sale? Drop your strategy in the comments below. Take these lessons, keep compounding, and above all else, stay quiet.